Uh, Welcome everybody to workshop number 1 on deal sourcing as part of the Atlanta Venture Capital Case Competition. We are going to cover the following topics. So we're going to talk about thematic deal sourcing and opportunistic deal sourcing. We'll do a little bit of a group exercise, and then we'll basically wrap up. But we'll set up a few breakout rooms with me and Christy and Rocky in case you want to hop in one of those rooms and just ask more specific questions about the deals that you're looking at specifically. So get a little more individualized feedback. All right, so in the world of venture capital, there's kind of two different ways of sourcing an investment opportunity. One is what we call thematic, and the other is opportunistic. The way I like to think about thematic is you're kind of like the guy on the right or on the left. And you're going out and you're hunting for that one deal that you think is going to be just the best deal ever. And you get it in your sights and you pull the trigger and make the investment, right? That's thematic venture or thematic investing. And just like being a hunter, you go out there, you do a lot of prep work, you understand like where the territory is, the type of animal you're hunting, all of those same things apply to startups. And we're going to talk about that in more depth. The other way is more opportunistic. And this is where deals kind of come to you, but it does require a lot of work. And so it's closer to being like a farmer. You go out and you build relationships, you cultivate those relationships, and then over time, those relationships yield intros to interesting companies, right? So most venture funds, this is a little bit of a spectrum, but most venture funds fall somewhere on the spectrum of these two types of deal sourcing. Sorry about that. How many of you have heard of Sequoia, the venture fund? Anybody? Yeah, got one hand up. So Sequoia, if you haven't heard of Sequoia, you've definitely heard of the companies that they've backed, right? Robinhood, Dropbox, Apple, Google, LinkedIn, Yahoo, WhatsApp, Instagram, EA. So Sequoia, what's interesting about Sequoia is you would think if there was ever a fund where the door swings open from deal flow perspective, right? Everybody goes to Sequoia and tries to get them to fund their deal. You would think that Sequoia has a very opportunistic approach to deal sourcing. That's actually not true. Sequoia has a very thematic approach to deal sourcing. And what they do is they will look around the market and they'll say, this is where we think the industry or the market's going in the next 5 to 10 to 15, 20 years. And then they will identify which company they think is best poised to be the winner in that market. And they will go and fund that company. And when Sequoia comes and knocks on your door, that's a knock you answer, right? And so they leverage their brand in order to get access to great deals. But most of what they do is going out and using a very thematic play and identifying opportunities. And that's partly why they've been so successful. So what does that mean? So a thematic approach could look something like this. This is what's called a Lumascape. There's a company called Luma Partners, consulting firm, and they prepare these Lumascapes where they look at a lot of different industries, and then they populate those broad industries with all the different companies that fit in within different parts of the value chain. So in this case, right, you've got, this is agencies like marketing and advertising agencies that are out there. And you have different types, right? You have creative agencies, you have digital agencies, you have media agencies, you have companies that provide marketing and data services, from an agency perspective or a technology perspective. You've got public relations agencies. And then down below, you've got these independent companies that provide a lot of technology to support a lot of these agencies. And so you could come in here and you could say, I think that there's a huge opportunity to digitize in the digital agency world. I think creative will always kind of be here, but like as everything is moving online and on our phones and so on and so forth, the real opportunity here is in a digital agency, right? And so then you could start looking at all the companies in the digital agency space, identify which one you think is best poised to take over the market and perform very well over the long run, and invest in that company, right? That would be a very kind of thematic approach. And so as you're thinking about your deal sourcing and where you want to spend your time, it might be worthwhile to take a step back and think about, where do you think the big opportunities are going to be going forward, right? Is it maybe you think it's going to be in cryptocurrencies, right? You just think that there's a huge opportunity around cryptocurrencies. And so now then the goal is, within crypto, that's pretty broad. So you want to narrow it down to maybe some sort of subsector. So like maybe you think there's an opportunity, everybody's going to hold all this crypto. So how are they going to hold it? They could just hold it on the exchanges, but what if it really becomes a currency? In that case, they're going to want like a bank account, right? So then you could go and look at all the different companies that are doing banking services, but for crypto, right? For example, right? And so you could go out, find all those banks that are out there, do your diligence on them, identify which one you think is the best, and then reach out to that company and pitch them on letting you invest, or in this case, pitch them on letting you analyze them as part of this competition, right? That would be a way in which you could use a thematic approach. And by the way, there are lots and lots and lots of markets and industries that you could dive into, right? So this is just marketing technology, broadly speaking. And each one of these subsectors that you see with the boxes, the text in the boxes, represents like a whole like subsector that you could invest. Like there are huge companies that exist within each one of these. And so you could pick one and you could say, okay, influencers, I think influencers are going to be the next big thing, or that, influencers are already a big thing, but, you think about how do you leverage influencers at scale, right? And so you start looking at technology companies that help brands manage all of their influencers at scale, right? For example, or maybe you look at like e-commerce marketing, right? What companies are there out there that do that really well? Or what kind of companies do content marketing really well, right? So there's a lot of different sectors here. So if you want, go ahead and check out Luma Partners or Lumascapes. They've got some really good stuff, especially as it pertains to marketing and advertising. But also just think for yourself about, hey, what are some areas, what does the future look like, right? And what kind of companies are going to help get us to that future? And then going from there, hone in on trying to find the very best one in that industry or space. So that'd be a very thematic approach. The benefit to a thematic approach, by the way, is that unlike an opportunistic approach where the deal flow kind of comes to you, with a thematic approach, you're a bit more in control of your destiny, if you will, right? You basically can do a bunch of research and identify where you think things are going, and then be very thoughtful about identifying the very best company within that space, as opposed to hoping that the very best company in that space comes to you, which can be tough and challenging to do. All right, let's talk about opportunistic approach. And the reality is, in this case competition, you're probably going to do some blend of both, frankly. And that's just part of the challenges of this competition. But I want you to be well versed on both, because part of the goal of this competition is not just to teach you what you need to know to win, but also to give you exposure to the world of venture. So in an opportunistic approach, you're looking for great deals generally, rather than looking for the best deal in a specific industry, right? So the deals kind of come into you. And the way that happens typically is venture capitalists are networkers. They're people, right? And so they go out and they meet with a lot of people and they build relationships. And then that in turn results in, when companies need money, that kind of flows through their network, right? So I'll give you an example in my own personal life. I met a guy who was helped run an accelerator, and we became really good friends, and we just stayed in touch and hung out on occasion and swapped notes on stuff and made intros back and forth on different things. And then a number of years ago, he connected me to a company called Carta, which is in our portfolio company, one of our portfolio companies, and met with them and ended up investing. And it's gone on to be an incredible company that was recently valued at $6.9 billion, right? So that's a very typical opportunistic approach, where you build relationships, usually for kind of the long run, and over time, some of those relationships yield interesting investments. And then the onus is on you to determine whether or not the deals that come into you are good or not, right? Now, you still have to refine your approach to some degree. So what I mean by that is there are some funds that will say, look, we can't just look at every single deal that comes in the door, because how will we be able to tell the difference between an apple and an orange, right? But if all we do is invest in apples, we'll be able to tell if the apple is a really good one or not, right? So you have funds that say we only invest in travel, or we only invest in enterprise software, or we only invest in consumer products, right? And what that does is, over time, it gives them a lot of expertise. Well, it does two things. First, it gives them expertise on evaluating companies within that sector, right? Because if all you do is consumer products companies, you're going to look at a lot of consumer products companies. And so when a good one comes along, hopefully you'll be able to tell, like, hey, that's a really interesting company because I've seen so many, right? I can kind of parse out what's good and bad from all the deals I've seen over the years. The other thing that it does is that when you become known as like the best at doing consumer products investing, deal flow naturally flows to you, and some of the best deals flow to you, right? So a good example of this is a fund called Forerunner Ventures. And they have built, they are very laser focused on just doing tech-enabled consumer products. And so that's what they do. And they have done incredibly well. They've backed some of the best brands out there. And now, not only do they have like great expertise that allows them to just continue to accelerate their ability to pick winners, but all of the great consumer products companies go to them to pitch them on why they should invest in their fund. And so from an opportunistic approach, that's like perfect, right? Deal flow just flows into them. Like the types of deal flow that they want flow into them all day long. All right, so what does that mean for you? So what does that mean for you? That means that you should be looking for a company. Well, let me back up. So you're probably going to have to sit somewhere between those two, thematic and opportunistic, from a deal sourcing perspective. I would encourage you to, broadly speaking, have a few areas where you're either super passionate or you just have some experience in, or whatever it might be. But I would pick a couple industries, if you will. So maybe it's like you will just love crypto, right? You've been buying it since you were in high school, right? You've been buying Bitcoin since you were in high school, and you just think crypto is the next big thing. Or maybe like you really like fashion, right? Or you like consumer products. And so like you're going to hone in on those types of deals. I would recommend you pick at least one or two or three kind of sectors to really focus on. And then what you're going to do is, to the extent you can, reach out to companies and get them to engage with you and provide data. That's awesome. And you should definitely try to do that. But if you can't, you can go to these platforms like WeFunder and Republic and Start Engine and very quickly say, I want to look at all of the crypto deals across all these different platforms. I want to narrow down to the ones that I think are the most interesting. And then we will pick the one that out of all of those is the most interesting. And that will be our deal that we pitch, right? So it's a little bit of thematic because you're being very thoughtful about like which company you're going after, but also opportunistic because in a way, these platforms are kind of feeding you deals, right? You don't have to go out and hunt down the entrepreneur. So then that begs the question, what should you be looking for in these deals? So let's say you figured out like, this is generally where I want to focus. What do you look for? How do you parse out the wheat from the chaff, right? So the first thing is that I look for are companies that have a unique product or business model. Do they have some sort of competitive advantage? Or another way to put that is, do they have an unfair advantage, right? Is there something about them that gives them a unique ability to compete and win in a marketplace, right? And if you think about like some of the best companies out there, they all have a very strong competitive advantage, right? Think about Facebook and Instagram, right? Everybody, for the most part, is on Facebook or Instagram or WhatsApp because everybody is on Facebook, Instagram, WhatsApp, right? And that becomes a really, really strong barrier that's hard to overcome, right? Because if you want to set up a competitor, you have to get everybody onto the platform, right? It's a bit of a chicken and egg problem. How do you get everybody on the platform so that they'll all want to be on the platform because everybody is on it, right? So that gives Facebook this huge competitive advantage. If you look at a company like Google in the early days, right? We talked about them last week. They had a much better way of organizing data and serving up search results. And what was interesting about that was they started indexing lots and lots of websites and lots of content, right? And so that allowed their whole software to get better and better and better and faster and faster and faster. And so it became more and more difficult for other companies to catch up because they just had access to so much more data. And they were doing they've always done a very, very good job of kind of parsing out that data so that their search results are always highly relevant, right? And so that's what you're looking for. Now, here's the thing. Most companies do not have a huge competitive advantage day one, right? They're new, they have an idea, and that they're approaching it in a unique way, but they may not have an advantage that can't be somewhat replicated by somebody else. So you want to be looking at like, what does the future look like? Could this company develop over time a competitive advantage that would keep competitors out so that by the time everybody figures out that what they're doing is the right thing to do, it's already too late and they kind of own the market, right? So like Lyft and Uber are kind of good examples of this, right? Everybody kind of scratched their head when Uber launched because they were providing, an app for black cars, and they're like, that seems like a really small market, just like, black cars. But over time, they were able to expand that. So they basically got all of the private, like black cars and limos, right? So they basically got all of the black cars and limos on their platform. And then they started opening up to peer-to-peer. And by the time they got to peer-to-peer, it was already really hard for somebody to catch up because they already had this installed user base from all the black cars and limos that they could leverage to help launch their peer-to-peer marketplace. Okay, so competitive advantages, there's lots of different types. We'll spend some more time talking about that in subsequent training sessions, but look for something that's unique, right? And that's hard to replicate. The next thing is you want to look for companies that have a really big market. Now, keep in mind, they'll probably change their business model and maybe even change their product offering, but generally they'll stay within the same broader market. And you want to make sure that that market is really big. And the reason for that, right, like we discussed last time, is you've got these funds and they've got to invest in these companies that can get really, really big, right? Because, you know, one fund is probably going to return your entire fund, hopefully, right? If you do a good job. So they need to operate in just really, really big markets. The other thing is, if your market is really, really big, you don't have to be the biggest, largest, most dominant player in the space to still generate a good return, right? You can shoot for the moon, you can shoot for the stars and land in the moon and still feel pretty good about that. The other thing I'll just mention about big market is that it doesn't have to be the biggest market today, but you got to be able to believe that over time it will become a very big market, right? So going back to my Uber example, when they launched with like limos and black cabs, like how big is that market really? It's really not that big, right? I mean, there's only a handful of cities that really offered that sort of transportation service, so on and so forth. And so you could look at it and say, well, it's kind of a small market. But the way to really look at it is Uber operates within the transportation market, which is like $1 trillion plus market, right? Much, much bigger. All right. And the next thing that we look for is, do they have just a killer team, right? So does the team have experience? Are they passionate? Do they have team market fit? Now, one of the things that that kind of goes around is this idea of a learned secret. And a learned secret is something that the management team has learned, they've paid the price to learn, that gives them an advantage in the market, right? So I'll give you an example. We looked at a deal a while ago. We ended up not doing it for a number of reasons, but what was really cool is you had this guy whose family was in the grocery business, grocery stores. And he had an engineering degree, I believe, from a top institution like MIT. And what he found, he took his knowledge about the grocery space, right? And all of his experience growing up working in the family grocery stores, if you will. And he coupled that with his knowledge about thermodynamics and engineering and so on and so forth. And he identified this huge pain point. And that is that in the restaurant or in the grocery industry, the freezers and the refrigerators that hold all the food, there's basically two companies that own like 99% market share of those refrigerators, and they compete mostly on price. And so the quality of the fridges and freezers is really low, and they break down. And when they break down, it can be catastrophic to a grocery store, right? Because grocery stores operate on very thin margin, right? They don't make a lot of profit. And so when you have your freezer go out and you lose a whole bunch of frozen items, that can be very, very costly to a grocery store. And so what he did is he built a very elegant solution that lowers the temperature of the goods with the product in the freezer to a lower freezing point, and then used that energy essentially that he had stored in that, so that when the power would go out or would fluctuate or what have you, he could then pull like the coldness, if you will, out of the ice cream and feed it back into the rest of the refrigerator freezer sections to maintain a more constant temperature. So it's just like a really interesting approach, and something that like I had no clue about any of that, right? And I think most people had no clue about any of those things. And it was something that he had to earn, if you will. So one of my favorite questions I love asking entrepreneurs is like, tell me about your origin story for this company. Like, how did you come up with the idea? and trying to tease out, like, do they have an earned secret there? Or did they just see like a somewhat interesting opportunity where they think they can make a lot of money? And that's why they launched the business. And I'll tell you, the entrepreneurs that tend to be the most passionate and the most willing to like just grind it out day after day are the ones that have earned like their secret in terms of how they view the world and how they believe that the problem that they're solving should be solved, right? And they're building a product to do it in that way. And if they can do that, that's what we call team market fit, right? They're the right team to provide a solution for that market. Just some other things to look for in potential deals. So can it scale super fast? Or in other words, is it like software, right? If it's a consumer product business, every time I sell another widget, I got to go and manufacture that widget and then sell it to somebody else. Software, I make it once, I write the software once, and I can sell it to as many people as want it, right? And I just have some server costs to store it, and that's about it. So you want to look for businesses that can scale really quickly. I'll tell you what, though, there's a really interesting business model in the food space that just popped up. So there's this concept called ghost kitchens, which are basically these kitchens that exist in warehouses, and restaurants can basically rent out some of that kitchen just to do deliveries. So when you order food from like DoorDash or Uber Eats, there's a decent likelihood that the food will actually come from one of these warehouses and not from their retail location. So anyways, so this company, what they did is they built a hamburger business and overnight opened up like 300 locations across the country by leveraging these ghost kitchens. So even though they're selling hamburgers, it's an incredibly scalable business model, right? So don't think that just because a company sells physical products that they can't scale, because they can. You just want to make sure that they have that potential, because you can't wait forever for this company to get big, right? As a venture investor, you've only really got like 10 years, 7 to 10 years, which seems like a lot, but it really isn't that much time at all. Do they have unique access to their target market or partners that can get them unique access to the target market, right? So in my burger example, right, they went out and built a relationship with like 300 ghost kitchens. And so overnight, they could just flip the switch and start delivering hamburgers and French fries across the entire country, right? So they went and built all those partnerships. It could be that you have a company that has super unique access, right? So, it's an individual. So I'll give you an example. We're an investor in a healthcare company where one of the people on the management team is incredibly well connected to lots of other healthcare companies. And so he's able to help this company that we invested in get their foot in the door with these other healthcare companies and sell to them, sell their product solution to them. So they have, unique access. We talked about like operating in a huge potential market or a huge market, but sometimes it's a potential market, right? So Airbnb is a good example of that. When they launched, it was like, how many people sleep on people's couches, right? But today, it's a company that's valued at over $100 billion and facilitates travel all over the world and creates, it kind of operates in the hotel industry, but in a way it's totally different because it's people that are seeking an experience in many cases, as opposed to just a place to sleep. Does it have unfair advantages over competitors? So like network effects. We talked about how Facebook can have those. That's what a network effect is. The stronger the competitive advantage gets stronger and stronger the more people that are part of it, right? Or in other words, the value of the product goes up with each additional person that joins and uses the product, right? So Facebook on day one, when it's just Mark Zuckerberg, not super valuable to anybody, right? But like once he gets everybody in Harvard on it, then it's really valuable to everybody at Harvard. And then the people across the street at MIT are interested in joining too, right? And so as they join, then it becomes more valuable and more valuable. So that's what network effects are. if you can get network effects, they tend to be the strongest competitive advantage over the long run because they're just so hard to displace. And then the last question you have to ask yourself is, can this business create liquidity in the next 5 to 10 years? In other words, can it be acquired or go public? There's lots of great businesses out there that, you have to ask yourself, can this thing actually get big enough to go public? And if not, who would buy this thing, right? So, for example, I could open up a gas station, and that could be a great little business for me down the street. But it's not likely, I'm never going to be able to take my one-off gas station, location public. And it's not likely anyone's going to really want to buy it from me, right? At least not at like the value that a venture investor would want. And so it could be a great little business, but maybe not one that you would want to invest in as a venture fund, right? Sometimes you see this with consumer products, where you look at it and say, really cool idea, and probably a great little business, but I'm having a hard time seeing why somebody's going to pay me 10 times what I'm paying to invest in the business today. I'm having a hard time seeing why they are going to pay me 10x that in 5 to 10 years. So you got to be looking for a company where you believe that somebody would buy them or they could go public so that you can generate a return and then give that money back to your investors, right? Which is why they're investing in you. All right, so just some general assumptions as you go out and look for deals. We talked about this before, but the assumption is you're operating a $50 million fund. You're in year one of a 10-year life for that fund, which means ideally you make all of your investments and you return all the capital that you invested plus all the profits in 10 years. You are targeting 30 to 50 seed or early stage deals. Now I'll add a little asterisk to that because you could actually change your strategy here if you want, but the $50 million fund size remains constant. So if you want to do fewer than 30 to 50, by all means, go ahead. You can make more concentrated bets, or you could take an even more spray and pray strategy and do more than that. But you need to defend how much you want to invest in the deal or how much you plan to invest in the deal, what your ownership targets are, and if you're going to reserve any capital for follow-on investments. So oftentimes, right, what happens is I make an investment in a company and then fast forward a year to 2 years, they need more money because they've spent all my money growing, right? So now I need to put more money in. If I don't invest more money than other people invest, then my ownership percentage of the company goes down, right? And so I may want to put more money into those deals. And that's why I would reserve capital for follow-on investments. Those are my reserves. Now, ownership targets can be important, right? Because if I have a $50 million fund and I make 50 seed stage investments, then I'm going to deploy about $1 million in every single deal, right? Well, if a company goes public or gets acquired, I'm going to need to own enough of that company so that they can return my fund on that one deal, because there's a high likelihood that most of my other deals are going to go to zero, right? So if I put $1 million into a company, I need $50 million back for that ownership. That means if they go public at $1 billion valuation, I need to own 5% of the company, right? Because that would give me $50 million back. So that's kind of why your ownership targets matter. You need to come up with like a good ownership target so that when you're defending this to the investment committee at the end of the competition, you can say, okay, we're going to invest at this valuation that will give us this ownership percentage of the company, right? So if it's a $5 million valuation or a $4 million valuation, and we're going to invest $1 million, so we'll own 20% of the company. And then we anticipate we'll probably get diluted over time. And so that ownership percentage may drop to like 10%. But we think this company could get acquired for $500 million. And here's all the reasons why we think that, right? Now you've been able to return your fund on that one deal, because you, even though you own 10%, they get acquired for 500 million. That's 50 million bucks and you're good. So, okay. So let me pause there. Any questions on that math there, or did that make sense? All right. If it didn't, hit me up in the chat and we'll dive in and make sure you understand it. So some places to look for deals. I shared this list last time. So Circle Up is great. They do a lot of consumer products. Start Engine, WeFunder, and Republic are the biggest ones. So we'll definitely take a minute here in just a moment and dig into those. And I'll show you how I think through a deal in real time. And then look, if you want, you could do an initial coin offering. That's what an ICO is. That's where a company creates a cryptocurrency and they launch it. So if you want, you could invest in one of those. There's lots of different places you can go to find deals. All right, so let's take a moment here, and I'm going to pull up WeFunder and Republic, and we're going to just pick a deal or two and talk about it. That sound good? Okay, can everybody see my screen? All right, sweet. So this is Republic. I'm a huge fan of Republic. Here's the thing with the Republic. So you've got Republic on one end of the spectrum, in my opinion, and you have WeFunder on the other. Republic, their history dates back to, they're a bunch of former employees of AngelList, which was one of the first companies that did this whole concept of equity crowdfunding. But it was only for people that were accredited, or in other words, it was only for rich people. And anyway, so this team spun out of that and said, we want to bring, angel investing, high quality deal flow to the masses. So that's Republic. Their deal flow, they are way more picky on the types of deals that they allow on their platform. They tend to have a slightly more social bend to the types of companies that they have on the platform. And I think in some ways the quality of the stuff they have is really, really high. In other ways, though, because they are so restrictive, I think in some cases they miss out on some deals. WeFunder is the opposite end of the spectrum. Their history is like a bunch of entrepreneurs. They went through Y Combinator, which is one of the top accelerators in the world. But they were like, from the get-go, we want to bring this to the masses, and we also want to help entrepreneurs raise money. And so they tend to be a little less selective. And they hustle a lot more. I'll just put it that way. And so sometimes entrepreneurs find it really, really great and super easy to work with them, right? So I would say generally with WeFunder, there's a lot more companies out there that you kind of have to sift through, but there's some really strong winners. Both platforms are great though. So definitely recommend taking some time looking at both. All right, so let's kind of just skim through here and let's pick one that we think is interesting. If you see one, go ahead and throw it out in the chat that you want us to dig into. Otherwise, I'll just kind of skim through here and then pick one. All right, so let's do this one. This is kind of an interesting, let's see. Somebody have one? Let me see. Nada. Let's see, where's Nada? Nada. Okay, cool. So let's talk about this one. Buy and sell your home online, pay nada. Okay, so one, the sold out, but I mean, I guess that's a good thing, right? They sold out pretty fast. So real estate tech eliminating costly realtor fees with technology. Okay, so that's kind of a cool idea, right? Like if you haven't bought and sold a home yet, like the realtors, they take 6% of the transaction. So if you buy a $300,000 home, that's $18,000 that you're going to fork over to the realtor. And the question is like, does the realtor actually provide that much value? Do they provide $18,000 of value to help you facilitate that transaction? I don't know. Okay, so let's look through there. So I think the pain point is pretty clear. They're raising 500. Let's see, they raised 500,000 from successful fintech investors. So that's good. So they've got some people that have been there, done that believe in them. Backed by University of Texas Accelerator and Google Startup, founding team with 10 years of industry experience and startup experience. So that's good. Business partnerships with Young Alfred and Aceable Agents. So they've got some interesting partnerships, not massive, but and establish product market fit with strong unit economics and scalable growth. All right, well, let's dive into what that means. So here they talk about just what I just said, right? You spend a lot in realtor fees. Let's see. Hey, Sky, I'm gonna go ahead and mute you if that's all right. All right. So 60%. Okay, so yeah, we get it, right? There's a lot of fees. You miss out on a lot of fees. So what do they offer? Sell your home. So they've got the realty, loans, insurance, and other services. Okay, so it's like a full stack, right? You work with them and they help you sell the home, buy the home, get the mortgage for it, insure the home, provide services, and so forth. So you save a bunch, blah, 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 less stressful, and you have this whole team of people to help you. So that's cool. And here's their product. So nice looking app, chat features. All right, but I want to know, how do they defining product market fit? So they launched in 2019, 3,000 signups, 75% convert to their mortgage financing and title services. So that's pretty good. And they generated over 700 or 250K in revenue. Great. So they've that's great. They've got some real revenue in the business, right? And if you think about their market, like it's everybody that's bought or sold a home, right? So huge potential market. So they've got some nice reviews. How do they make money if they charge nada? So let's see. They charge on the buy side, looks like, and then they charge for their title service, their mortgage service, and their insurance products. So that's how they make money. They don't charge you anything to sell. So that's how they get you. So if you're selling a home for $300,000 and then you go and buy a home for $400,000, they'll sell your home for free, and then they'll basically make money providing all of these services, which is cool. And then they pay about $1,400 to acquire a customer. And here's their growth projections, which are like a rocket ship up and to the right. That's how every startup growth projections look like, which is good. And strong unit economics. So this, their gross profit to customer acquisition costs. So what they're trying to do there is they're trying to say, how long does it take, or not how long, if we spend $1 to acquire a customer, how many dollars does that customer bring to us in value? And what they're saying here is that it's today, going back, it's about 2.64x, right? So all the way over here on the right, they've got all these great looking numbers. These are amazing numbers, right? But today they're actually at 2.64x. So I spend $1 and that customer is going to bring $2.64 of earnings back to me, right? I mean, it's not bad. It's not world class, but it's not bad. And they're early, right? So they'll still learn. They think they'll get to profitability next quarter. That's impressive if they can. Huge markets. We talked about that. Okay, so competition. Here's one of the areas where I have a problem with this company. I actually know several companies that operate in this space because we've looked at some of their competitors, and certainly Redfin and Open Door are competitors, but man, there are like 5 or 6 very well funded, very well established competitors that are a lot further ahead or further along than these guys in other markets. So that's a question I have right there, is that you really would want to dig into some of the competitors here. And that's not uncommon, right? Entrepreneurs will oftentimes say, we don't have any competitors because nobody does it quite the same way that we do. But what you have to ask is like, who else is really solving this pain point in not even in a similar way? Like if you solve the pain point, like you're probably a competitor, right? And then, you've got these traditional players which own 80% of the market. So you'd want to dig in a little bit on that. Okay, so things that are good about this deal. Big market, right? I love that they've gone out and they've generated revenue, 250K in revenue. It's not huge, but it's enough to say, hey, people like our service and they're showing that by giving us dollars. Their model seems to make sense, right? I'm not seeing a lot here that says to me that like they're going to be able to build a huge competitive barrier from other companies competing with them. But maybe over time they can build an interesting brand around this, and that brand will provide some sort of competitive advantage. So there you go. That's Nada. I think it's an interesting business. Let's go look at WeFunder. Let's see what WeFunder's got here. And again, if you see one that you want to dive into, let us know and let's talk about it. And at this point, I'm not digging in super deep. I'm just trying to gauge, like, is this a company that I should spend some more time on or not, right? Like, are there any like quick deal killers? All right, we're going to do this electric motorcycle one because my business partner loves motorcycles and it's a consumer products company. So it'll be fun. All right, that's a pretty interesting looking motorcycle. All right, let's read down. Okay, so highlights, you can tell they're all kind of written the same basic way, right? It's like highlights and then kind of walk you through the thesis. So experienced team. They hope to be net cash flow positive beginning of this year. Well, it is the beginning of this year. First 5 months of production are pre-sold, so that's great. Like they're fully pre-sold all their products, so people are willing to put up some money to reserve these things, and there's a lot of interest, so that's good. 20 units at 1 unit per week to begin. So it's pre-sold, but it's only 20 units. It's not a lot of units. And with this type of company, I would imagine that their gross margins are not super high, so they're gonna have to sell a lot more than 20 units. Okay, so let's look at these people. So, okay, so I want to dig in on this guy, Matt Chambers, and really understand why why he's so credible as an investor or as an entrepreneur. But 3 decades of experience, one of the world's most experienced OEM motorcycle executives. So yeah, I'd want to dig in on this guy. see what I could learn about him. I don't see any other information on him, but so, okay. So it looks like you've got some decent people here with good experience. Here we have the motorcycle. It's very, very, what, artistic? I don't know. It's very different, right? It's very original and unique. So if that's, you're the kind of person that likes driving a Lamborghini and everybody turning heads, this is probably the type of motorcycle for you, right? It's a problem. We feel like there's never been true luxury two-wheeled motoring. I think a lot of people, Harley Davidson and Ducati riders, might disagree with you on that, but fair enough. That's their pain point, right? I think your question would be like, how do I know if this problem that they're stating is actually true, right? Are there a lot of people out in the market that believe that there hasn't been true luxury on two wheels or not provided? And are there enough of those people that believe that to buy these products and build a big enough business? So they talk about all these different things. So what I'm not seeing here is anything like super unique about their technology. To me, this is like a design play, and which is really at the end of the day like a branding play. Like, can they build a really unique brand? And in motorcycles, right? Like Harley Davidson, Ducati, some of these companies, they've built like iconic brands, but a lot of them have done it on some sort of technology advantage that they've built into their bikes. So these e-bikes, they talk about the market. It's really big. It's $7 billion and growing at 60% CAGR. That's really strong. 60% CAGR is really strong growth by 2026. But it kind of makes sense, right? Everybody's switching away from gas motorcycles to electric. The question you have to ask is, how many of those people that are going to dump their gas guzzling, polluting Harley Davidson and go and buy one of these, or are they going to just go and buy an electrified Harley Davidson, right? So competition is a bit of a question there, I would think. So traction, let's see, they've got 20 units pre-sold and they've got 650 expressions of interest. I mean, it feels really small to me. The bikes look cool. There you go. That's kind of all the information we've got. So big questions I would have. I think the market's really big. I don't know how much of that market they could really get though. And the market's growing really fast, but again, is that growth from people just switching from gas motorcycles over to electric, or is it more people entering, like net new motorcycle buyers entering the market, right? Ideally, you'd want to be in a market where the growth, like motorcycle growth, really, I don't think is growing that much. It's just the e-bike side of the market's growing really fast. So generally, I'd want to see markets where people are entering, like new buyers would be entering into that market versus just switching over, because that would cause me some concerns. The team looks like they have a lot of experience, but it kind of feels a little bit like a passion project and less about a deal that's really like scalable and venture worthy, if you will. Like, can they really grow this thing to shipping? They probably need to be shipping like thousands of motorcycles. And by the way, there are venture backable companies in the e-bike space. So there's a company called Zero. And they actually do ship. I don't know if they ship thousands. They probably do ship thousands of electric motorcycles. So this is another one of your competitors here. And these are not cheap bikes either. I think they start at like $10,000 to give you an idea. So you've already got this company out there building really great product and selling it. So, all right, cool. Well, hopefully that was helpful in terms of just the things that I look for, right? Like, is it scalable? Is it operate in a big market? What's the management team like, right? So I probably pass on the motorcycle company. If it were my style, I'd maybe buy one, but maybe not be an investor. And I think Nada is a really interesting deal. I think you know, if this one's interesting, I'd probably dig in a lot more to understand the competitive landscape and how they're going to try to differentiate themselves from the other players like Homey and Rex, um, and Redefy, and I mean, there's just a bunch out there, right?
Hey, if possible, can we go over the deal terms that are on the page?
Sure. Yeah, we're going to talk more about deal terms in another training, but yeah, we can hit it right now.
Oh, sorry. Okay.
No, you're good. So let's talk about deal terms. So you've got a valuation cap. Okay, so this is a convertible note in this particular deal. What that means is it's actually a safe, but a safe is just really a convertible note at the end of the day. What that means is you're going to invest into a debt instrument where the company like owes you the money back, right? Like a debt holder, but they're going to convert it into equity at some future date. And so what they're saying here is the cap which it will convert will be no more than $12 million. And if it's below $12 million, it will convert at a 20% discount to that valuation. So let's say you invest in this company, fast forward, they raise a round of financing from a venture fund at $10 million at a $10 million valuation. Your convertible note, your safe, is going to convert from debt into equity at a 20% discount to that $10 million. So at an $8 million valuation. So if you put in $1 million into the company, you would be buying it at an $8 million valuation. So you would own something like 12, 13% of the company. Now, what happens if they're really successful, right? And now the company, instead of being valued at $10 million when they raise their next round of funding, they get valued at like $30 million. Well, the reason why you have this cap is like, that wouldn't be fair. Like you came in the early days when like they were only doing 250K in revenue and they were only operating in one market and it was so risky. It wouldn't be fair for you to be converted at that $30 million valuation or even 20% off of that $30 million valuation. So it wouldn't be fair for you to get converted at 24 million. And so that's why they have this valuation cap, because it basically says, okay, if we raise a round of capital at $30 million, your investment will convert at $12 million because you took the risk and you believed in us early on. We're guaranteeing that we're going to give you a better valuation than the next investors are going to get, because we'll either cap it at $12 million or we'll give you a discount if it's below 12 million. Does that make sense, William?
Yes, it does.
Cool. Any other questions on that?
No. There was one on the other one for the motorcycles. It
Yeah.
was talking about scroll the 8.3 million. Oh, okay, it's the same thing, but okay.
So in this case, it's a priced round. So it's not a convertible note. You're
Okay.
actually buying stock equity in the company. And so what that means is, yeah, you're buying it at $8.33 million pre-money valuation. And they've done this little like early bird term. So if you invest today, you get in for 8.33. If you don't get in time, you're going to have to pay 13.9 million in valuation, which is a pretty big jump. It's like almost 50% bump. So,
Okay. Thank you.
yep. Yeah, great questions. Oops. All right, let's go back to the presentation. Um, All right, so we're just wrapping up here. So just a reminder. So right now we're doing workshop number 2, which is deal sourcing. End of this week, March 6th. Get registered. If you still don't have a team, no problem. Just let us know. Shoot me a note in the chat personally, or shoot an email to vccc@ugrowthfund.com. Let us know. Or on the intake form, when you register, you can just register as an individual and just check the box and say you don't have a team. We will help find you a team. We want everybody to participate. We will help find teams for everyone. So please come join us for that, and make sure you apply by March 6th. Next week, we're going to dive into due diligence. And so what I would like is, you can ignore that top through 30 teams. But what we do want is everybody to submit 3 companies that they're excited about by March 13th. That doesn't mean you have to evaluate one of those companies as your final company. But ideally it is one of them, and we want you to submit 3 because it'll force you to have 2 backups, if you will, just in case you're doing your diligence and you find out something that just is horrible about the company and you want to kill it, so you don't have to start from scratch. You can just pick up one of those other 2. In terms of due diligence 1, we're going to cover market and competitions, and then due diligence 2 is going to be a lot more financials, valuation, those types of things, as well as some guidance on what to do to prepare. Let's see, are the companies being selected from the websites we just looked at? They don't have to be, but they can. So you can source deals anywhere you want. We don't care where the deal comes from. The only caveat to that is that you have to be able to get some level of financial data. And almost all of the companies on WeFunder and Republic provide that data. And so that's why we recommend them, because it can be a very easy source of sourcing a deal. But I would say a lot of the teams that do really well in this, they reach out to companies that they think are really exciting and convince the entrepreneur to share some information with them that they can use for the competition. We don't need a lot of information, but you got to be able to tell us like how much revenue they've done, or like what kind of pre-orders they have and what kind of margins they have, those kinds of things. And then, yeah, this is just the dates again. This is on the website, of course. And then we will send out a link to the recording of this so that you all have it in the email, as well as posting it to the website and seeing if we can fix what's wrong with our website. So we'll also send last week's recording as well.
I had a quick question on the assignment due next week, the 3 companies.
Yes.
Is there like an in-depth analysis required, or are we just saying, hey, I don't know, let's say we care about e-gambling. Let's say, hey, we care about this specific company. We just rank 3 of them and send them over, or are we also adding why we think it's an interesting space?
Yeah, so the way there'll be an intake form. So that intake form will go up after this weekend. Basically, we'll replace the registration form. And it's very simple. It's basically like name of the company, like website, and then like just a very brief, like, here's why we like it, right? So you don't need to spend hours explaining why you like it. You just be a couple sentences. So we don't want it to be a burden, but we do want you to actually like have some companies that you're excited about. So.
I have a question. Well, not more of like, but how, when you're in a situation, how do you assess the confidence of like the assumptions the fund has made or the investment has made? Like as you saw, like they were expecting their growth to go from X to Z in 2022 quarter four, how confident are they in those assumptions, and how can we find that out as someone who's looking into invest in them?
Yeah. So the cool thing about WeFund and Republic is you can just ask questions right through the platform of the CEO, and they oftentimes respond, right? So if you source your own deal and you're engaging with the entrepreneur directly, you can also have those same conversations and just ask them. So, ultimately though, it is tricky, right? I'm not gonna lie, like entrepreneurs all the time, like, so it cuts both ways. Would you ever want to invest in a company that couldn't achieve really high growth? No, you wouldn't, right? You're looking for companies that could grow really quickly. The flip side is, how hard is it to grow really quickly? It's very hard, right? So that's part of the challenge of doing your due diligence, is ultimately trying to decide if that makes sense, if their projections are possible and feasible or not. And that's where we're going to spend the next 2 training sessions kind of going through some of those diligence metrics.
Okay, thank you.
Yeah. Any other questions? Awesome. Well, if there's, tell you what, I'm going to open up just a couple of breakout rooms. If you want to hop in those, great. If you don't, and you want to call it an evening, by all means, don't feel like you have to stay. I just want to make sure that we're available if you want individualized feedback on any of the companies you're looking at or have any other questions. And then we will send out the recording of this to all of you as well. So if you joined a little bit late, no problem at all. You can just, watch the recording at 2x speed and get caught up.
I had one more question on the deliverable. Sorry, the 3-company deliverable.
Yep.
How will we be evaluated in terms of who makes it to the final presentations?
Okay, so on the 3 companies you're going to submit, everybody that submits them qualifies.
Sure.
Right?
Yep.
There's no like huge hurdle there. In terms of making it to the final round, the 5 finalists, we're going to look for 2 things, and they're pretty much equally weighted. One is, how good is your due diligence, right? And the other is, how good is your deal? Now, the 2 are very interrelated, right?
Yeah.
So if you hustle and you get yourself into like just an amazing killer deal, and your diligence is okay, but not amazing, like that's pretty impressive, right? We're going to give you credit for that.
Okay.
If on the other hand, like, man, you just struggle to get into a really good deal, but your diligence is amazing and you like, it's a good company, right? Like you've been able to prove that like, hey, this may not be like the deal of the decade, but like this is a solid company and I dug in really deep on the due diligence and I did a really good job and I can show that, then we're going to give you credit for that. So
Thanks.
and if you can do both, even better.
That's the goal.
That's the goal. Awesome. Any other questions? That's a great one. And that was one that we were going to hit on next week. So you'll probably hear me say all those same things again.
Jumping the gun.
No worries.